It is the most expensive purchase many of us even consider, a place to live. And as we head into 2019, a complicated landscape in real estate. For a decade in a rebounding U.S. economy amid cheap loans, home prices have pretty much marched steadily higher. When the market bottomed in February 2009, the median sale price for a home was about $140,000. Last month, it was nearly $258,000. That might sound okay if you're looking to sell a home, but not so fast. Interest rates are creeping higher, reducing how much buyers can borrow, and the number of homes for sale is rising, giving shoppers more homes to choose from. So, are we heading into a healthier housing market or a more dangerous one? Welcome to Fort Knox, rich ideas and powerful people. I am Jon Fortt at the NASDAQ market site in Times Square, and joining me to talk real estate, I have the very best. CNBC's Diana Olick, Realtor.com CEO Ryan O'Hara, and real estate agent Josh Flagg of Bravo's $1 Million Listing Los Angeles. Season 11 debuts on January 3rd, by the way. And later on the podcast, Intel's interim CEO Bob Swan joins me. Do not miss that. Diana, let's start talking about housing and 2019. We did this a year ago. People ate it up all year, continued to refer back to it. So I'm wondering, I want to start with sellers. If you're a potential seller in 2019, tell us about the landscape. I mean, what's different? What should you be prepared for?
Well, John, it's easy. What a difference a year makes. A year ago, we were seeing bidding wars on front porches, multiple offers, home prices overheating. It was crazy out there. There was so much demand, so little supply. And that has all changed pretty dramatically in just the last 6 months. We've seen mortgage rates go up, now a full percentage point higher than they were a year ago. We're starting to see more supply come onto the market, not really at the entry level where we need it most, but in general, more supply, more months supply, because homes are sitting on the market longer. Buyers have simply said, I can't afford this anymore. I've hit the wall, and sellers have to get real. They have to lower prices, and they're doing that in a lot of places. In fact, we're now hearing word that prices could be going negative in California, the highest priced housing market in the nation. For the rest of the nation, you're not going to see negative prices. That was something crazy that we saw, during the last housing crash. To see national home prices go negative is very, very rare. But we are going to see those big home price gains, those double-digit gains that we saw last year, the year before, really start to shrink back to, I have to say it, a normal housing market. How scary is that?
Yeah, I mean, that largely sounds healthy. I mean, I guess, what's the downside here? Because prices in California have been going nuts for years now. A little negative in California. I mean, along the margins, how bad could that be? But are there danger pockets here, either in people getting into homes that they can't afford, or the types of loans people are getting? What do you see?
No, not this time around. The difference here is the mortgage market. Mortgage underwriting has been very, very, and perhaps even overly careful over the last several years since the recession. So if you lose value on the house, it doesn't mean, most people today are in fixed rate mortgages anyway. They have been underwritten to that mortgage very carefully so that they can afford that monthly payment. So watching the home prices go negative a little bit, it's just on paper at this point. It's not going to affect how much you pay every month, and it's not going to affect what you can afford. If the economy is still strong, if you still have a job, you still have a good income, you keep paying on the house and you hope that the home price will go up again. If you want to sell and you bought at the top of the market, then it might be a different story. Let's say you bought, last January, and for some reason you have to sell, your job moved and you got to sell in California. You might lose some money, but that's not going to be a lot of people, and it's not going to be widespread. So you'll see the euphoria coming out of this market. But what that will do is allow more people to get into the market, to see more sales, because sales really slowed down this year, A, because there wasn't anything to buy, but then over the summer, B, because people couldn't afford what there was on the market to buy. So this will help more people get back into the market. I think you'll see things kind of flatline over 2019 when it comes to sales. There's still very strong demand. It's just when those prices get back to where people can afford it, then they will start buying. It's the sellers, you got to say, I can't reach for this guy. I have to be realistic. What can I do to sell this home? But then there's another problem there is we need more supply. We need those sellers. But let's say you're a seller. with a 3.5% 30-year fixed mortgage, and now you want to move to another home, but you're going to be paying over 5%.
Yeah.
I don't know if I want to do that. That might keep me in my house. That make me maybe want to renovate the house, because that's a hard thing to give up, is that rock bottom rate that so many people refinanced into that rate.
Now, tell me, one of the dangers, I think, is so often people really want to live close in a city, maybe where their job is, but it's unaffordable. So they start, maybe buying something further out. Not their first choice.
Millennials don't like to do that.
Right?
They hate that. No.
Well, maybe
they would rather live in a
that.
tiny little box downtown and pay a fortune for it than ride all the way out to the exurbs. And that's why the home builders aren't building cheap houses. They don't want to go out to the exurbs.
Here's my question, Diana, is in so many metropolitan areas, I know this is definitely true of the San Francisco Bay Area, if prices do turn down, if things do start to go south, it's those exurbs that feel it first and that feel it hardest. So I'm looking at this list. Markets that have more inbound traffic than outbound traffic right now. It's kind of a lot of those exurby feeling areas. Should buyers be cautious about moving into those areas, even if they have a long-term perspective?
Not if they have a long-term perspective. I mean, the reason you move way out is because you want more space. You want better schools. You don't want to be downtown. Why? Because you have kids. And when you have kids, you're generally more stable. You don't want to move them. They like to be in their schools. So most people who are moving out to the suburbs or buying a big house, they intend to stay there maybe 10 years till the kids go to college. So I don't think that's going to be a problem in losing money out there. You're seeing money, prices come down in the short term. They will stabilize and probably go back up again over the next 5 to 10 years, of course, because historically home prices go up. They just do. Values appreciate. And if demand and if the economy remains strong, you will see those prices go back up again. It's just going to be a little, dare I say, correction. That wasn't even my word. That was one of a home builder analyst we spoke to yesterday, John Burns from John Burns Real Estate Consulting. He's just the guru of home building. And he said, we're in a home builder correction right now. You just have to see the prices pull back. Because as he said, half of Americans can afford a $220,000 mortgage. That's all they can afford. But the average price of a newly built home, $440,000.
Wow.
So there's your mismatch going on with the builders. But the builders don't want to build out in the exurbs because it's riskier. They don't see the demand there. And therefore, they're building closer in, and that's more expensive for them. So they have to build more expensive homes. And that's the rub. Yeah, wow, that's 2x. Once again, this is Fort Knox. We are talking real estate as we look into 2019, what to expect, whether you're buying, selling. We'll get to refining also. And joining us now from San Francisco, let's bring in Ryan O'Hara. He is the CEO of Move, which owns brands like Realtor.com, Move, ListHub, and 5 Street. Ryan, great to have you. What's the major kind of dominant overall trend that you expect to see in 2019? And then let's talk regions. First on affordability, because that has been a theme that I know Diana has been telling CNBC viewers about all year, and that has dominated. What happens with affordability?
Yeah, thanks for having me, John. I'll say a couple things. We're seeing real trends from people looking on the coast to move into the interior states. So we have some interesting proprietary data from all the usage on the site. And we used to see people from small cities looking to the big cities, wanting to move there, wanting to see what inventory is like, what pricing was like. And we're now seeing the opposite, where we're seeing traffic in big cities looking at smaller cities. So a couple to note that I think are telling. We're seeing in Seattle, people in Seattle are looking at Spokane, Washington. Can they move there? Can they find a job there? Can they get more house? We're seeing the same from Boston up to Portland, Maine. We're seeing it with Miami and Daytona going into the outskirts of Orlando. So we're seeing these trends where people in the big markets, they're seeing the pricing rise to levels they can't afford or they want to take advantage of, and looking into smaller cities. I think we're also going to see some
boomers? Are these baby boomers or millennials? Because we have that huge generation downsizing. That would seem like maybe a retirement trend.
I think it's both. I think baby boomers have a higher percentage of home ownership. They're about 66% homeowners, whereas on the millennial side, it's more about 35%. So I think, as Diana said, millennials have been priced out of this market for a while. There's a huge rump of people millennials that haven't yet bought, and they really want to, but they've been priced out because prices have been so high. Now, will that change over the next year or two? We think in some places it will, and millennials will finally come into this market in a big way.
Those markets, Ryan, that you're talking about, and Diana and I were just talking about this, say you're Spokane, say you're Stockton in California, outside the Bay Area, say some of those areas outside Orlando, aren't those the same areas that 10 years ago got hit really hard when things turned down? I mean, do they tend to be perhaps more volatile in certain seasons if people are thinking about buying there?
Well, I think if you look at the local economies and you look at unemployment, which is really low in a lot of these cities, you look at wage growth, which is high, and you look at the amount of job creation that's happened in some of these cities, that's what's driving the market. It's the same in Milwaukee. We're seeing it in Indianapolis. We're seeing it in Memphis. A lot of these smaller cities really have robust economies, and people are moving there to take advantage of job creation, and also they can spend more and get more house.
All right, Ryan, talk about interest rates and the impact that's likely to have. The Fed is expected to hike. You know, here we are in December, in just a few minutes, as a matter of fact, but unclear what will happen throughout 2019. What's the impact on how long homes stay on the market, the way buyers start to view affordability when rates do start inching higher?
Well, higher interest rates definitely has a magnified impact on housing. So I think housing is more susceptible to increases in mortgage rates, for sure. I think what you're seeing is the last couple months with mortgage rates about 70 to 100 basis points higher than year prior, the market did slow. So just this morning, the National Association of Realtors came out with their November sales, which were down 7%. I think that's really tied to mortgage rates. However, the last couple weeks, we have had a slowing in the increase in mortgage rates. I think today's Fed decision was expected, but the number of increases next year, I think people are thinking is lower than they were a month or two ago. So it could have an impact where the increase in mortgage rates slow. Today, we predict at the end of 2019, mortgage rates will hit 5.5%. The average during the year will be 5.3 versus today, 4.7, 4.8. So they will go up. They're historically really low, which is a good thing, but people feel like they might have missed their window and missed their moment to grab a great rate. So sometimes that makes people stay in their home and not make that trade, as Diana said.
Diana, just kind of an offbeat question, maybe, and it's on the when to buy. I think we kind of know when to sell. There tends to be a lot of traffic spring and summer, but when to buy? Did I hear that right around this time, if you're closing like the day after Christmas, you tend to get the best deals?
Well, I mean, this is a funny story. We do it every year, is that everybody thinks that the holiday season is the absolute worst time to buy or sell a house. And it is definitely the slowest time of year. It has the lowest inventory of homes for sale on the market, but the buyers who are out there are serious buyers, because why else would you be out buying in December? You'd be out wanting to have fun, do something else. Buying a home is not particularly fun. And why would you sell in December unless you really had to sell in December? So deals do get made, and they get made much more quickly, and perhaps you can get a deal as a buyer, or maybe, you know, even as a seller if there's competition. Deals are good for the making in December because there's just not very much out there and there's not very much buyer competition. That said, there's not a lot to choose from. So is it a good time to buy in December? Sure. Is it better in the spring when there's lots out there to choose from? Well, it might be in the choices, but you're going to have a lot of other competition around you, so you might not get the price that you really want. You might not get the seller to come down to what you want. So, you know, timing the real estate market is like timing the stock market. It's like timing anything. It's impossible. You can have theories. You can look at some of the comps on, you know, what sells when and where, depending on the weather. But in general, you buy and sell a home when you have to buy and sell a home, and the most available homes are in the spring. The fall is probably the second best time. You don't have as many families out looking for homes because nobody wants to move their kids during the school year. So again, you have more single buyers out. You have people looking at lower price, smaller homes. There's a little more wiggle room in the pricing. And then December's that, you know, weird phenomenon that I just said.
Yeah. Well, I want to bring another voice into the conversation on the high end, the very high end. Joining us now from Los Angeles, he's a co-star of Bravo's $1 Million Listing Los Angeles. You can also catch him on his Josh Flagg YouTube vlog. Here's Josh. Josh, thanks for being with us. Tell me, first of all, you do big deals, a lot of big homes in and around Los Angeles. What kind of trends are you seeing these days in that set, which is very different from the broader market that we've been talking about?
Well, you know what? I have to say, Diana gave a great. She basically said everything I was going to say. So
sorry.
It's okay. You literally. Well, it's interesting because sometimes I think, do I know what I'm talking about?
Talk about the taxes. Talk about salt.
Okay, this is what I'm, basically, if you actually look at, aside from my vlog, I have something that's becoming pretty good, which is which is becoming Josh Flagg blog. And on the blog, literally, we are discussing exactly what you've said. And so let's talk about when is the right time to buy. And this is a theory that I've come up with. I feel that even though prices are higher now than they're going to be next year, there's no question prices are softening. Would I rather have a $50,000 a month, or sorry, let me just talk in normal, not LA terms. Would I rather have a $5,000 a month mortgage or a $7,000 a month mortgage when interest rates climb? So sure, if I'm living in a house for 30 years, why would I care if I pay a little bit more, a little bit less? Because the house is going to be worth 10 times more in the future. But do I care if I'm paying $5,000 a month or $7,000 a month? Certainly, I would rather pay I would rather be at a better interest rate. So now is really honestly, when they say this is the time to strike, I honestly think now is the time to strike. Yes, you'll be paying a little bit more for the house, but you are going to be paying far less, because I remember when interest rates were, well, I wasn't born, but I do remember interest rates I heard were at one time at 22%. So, but I do remember when they were 12%. So what I'm basically saying is it is okay and it is healthy for a market to correct itself. This is not going to be 2018, but if you bought a house last year, yes, if you have to sell right away, you're going to lose some money. But if you bought, the market has climbed dramatically in the last 2 years. So if you bought a house 2 years ago and compare it to what you're going to sell it for today, you're still ahead. You might have a problem if you bought last year, but now is the time to get deals, because the reason the markets start to drop, honestly, is because there's not a lot of inventory, interest rates go up, and sellers are stupid and they just keep at these ridiculously high prices. And when people see properties listed at high prices and they sit on the market and get price reductions, people see this happening all the time, and then mentally it turns a buyer thinking, uh-oh, we're having a market that's falling, when it doesn't even need to really happen. If people were not so greedy, and I don't know if you agree with this, Diana, if people were not so greedy, and sellers, if they were not so greedy and they would just be a little bit more realistic, they're hurting themselves, because you have all these spec developments coming on the market at the same time. All of them are asking 35 million, all these crazy numbers, and they're just going to sit there, and it creates an illusion that the market is dropping as they keep doing price reductions.
Yeah.
I don't know if you agree with me.
Diana, what do you think?
That's my
Always better to slightly underprice a home and sell it fast for more
100%.
money even than to overprice a home and sit and go stale, and everybody says, what's wrong with this? What's wrong with the market?
But not just for the seller. And I always say price your property right, and you'll get multiple offers. Nobody ever believes me, but that's a whole different story. But aside from that, do you agree with me that it creates an illusion when you keep seeing all these stupid sellers and developers listing their properties for ridiculous amounts of money because they think they're going to get it? And when you see 20 of them across the board, and you start seeing price, it creates an illusion for buyers out there that the market is dropping when it really doesn't have to.
Exactly. No, I don't know if it's an illusion or reality that the market has to be lower than it is and what they're listing, and when they say the sky's limit. I do see that from a buyer perspective. You're going to say, what's wrong with this market? And I'm not going to go into this market if I see 20 homes that are sitting there. And then, especially on the high end, when you see these ginormous price drops, which on a percentage level are not that much, but this $50 million house is now selling for $40 million. Oh my God.
Well,
that's a crash.
Well, it's an illusion and a reality. I think
but
it's
it never
both.
should have been listed at 50 million.
No. What I'm saying is 100%. What I'm saying is it's overpriced, and it's good in some. It's a reality because the market should soften a bit, but I think it softens faster because nobody thought ahead of time. Let's be a little bit more careful and delicate. Let's not really all go for these crazy prices. We could soften a lot slower than it would. But let's talk about. So it's an illusion and a reality.
The psychology,
it's a psychology.
Clearly a big part of this, and not just when it comes to pricing. Ryan, I want to bring you back in because the taxes are a part of this conversation, are going to be in 2019 in a way they weren't before because of the way that tax laws recently changed. I mean, there's a set of people who are going to end up taking the standard deduction who thought that they were going to be writing off their mortgage interest, right? Once we come down under that luxury set and we're talking about the bulk of maybe middle class, upper middle class home buyers, how's that going to affect the market?
I think it's a big question, and I think people are going to feel it in April when they file their taxes. I think if you look going forward, that $10,000 cap on both mortgage interest and also your state tax deduction, it's going to hit a lot of people in the pocketbook. So I think at the higher end, I think the estimates we've seen and we've studied is sort of 8 to 10% of households will feel it. But at the high end, it's really going to be an impact. It's going to be more expensive to own your home. Now, look, those folks can afford homes and will stay in homes. And a home's more than an investment. It's the fabric of your life, and it is everything about your family and your community. So people will stay in nice homes. But I do think it makes the cost of higher-end housing go up, especially in the high-tax states.
Diana, how quickly does the psychology really change around something like that, though? It seems like it could sometimes take years for people to shift the way they think about stuff.
Really? No, in a heartbeat. In a heartbeat, in a place like Manhattan. Now, I'm not saying, you got to look at these numbers. We did the math when the tax law was all being changed. We did the math.
Oh, good.
And these tax changes really don't affect the vast majority of homeowners. It does seriously affect the high end in Manhattan and in parts of California, that luxury owner. I was talking to somebody a couple of weeks ago, owns a co-op on the Upper East Side of Manhattan, gorgeous, on Park Avenue, wants to sell, downsizing baby boomer, and says he's terrified to sell into this market because he thinks that when it's already soft on the Upper East Side, it's already soft. And he's saying that he's afraid that in April, when people start doing their taxes, as we're saying, they're going to start to really see what this impact is. Nobody's going to want to buy. Nobody's going to want to sell to buy something else in the area. People are going to want to. He wants to move to Florida, and I'm hearing from Florida realtors that they're getting a lot of people moving out of New York to take advantage of the better tax situation in Florida. But he is petrified that the Manhattan market is going to stagnate because of taxes, and that it's all going to come to roost in April when people finally see those numbers on their own tax returns.
Josh, California is another one of those states that gets hit here. Your clientele, again, a little bit different, sensitivities to different kinds of things. How much is the tax situation change playing into your conversations and the way you're positioning things?
You know, let's go there in a second, but I was just thinking, I don't know, Diana, maybe you can answer this for me or what you think. I'm thinking, you know, the reason New York dropped so much is because it was so over the top crazy prices. Whereas I think Los Angeles, even though people are like, oh my God, $2,000 a foot. Yeah, it's like $14,000 a foot in New York, and think of all you get in the amenities you get in Los Angeles. That's why I think that we were underpriced for a long time, believe it or not, and I think that we kind of caught up to where we should be. So that's why I don't think we're going to see a tremendous drop, whereas New York went exponentially high, much higher than it actually is.
Well, New York was a problem with the bifurcated market. You had an oversupply of condominiums being built, and condos got very, very popular with foreign investors because you could buy, you could rent them out, you could sell them quickly and flip them. And, well, I'm not going to go there on the show. I'm just not going to go there right now. But condos are a lot easier, and there's such an oversupply of them. The building boom in condos and rentals apartment in Manhattan and in the boroughs is just phenomenal. But when you talk about, you know, that standard co-op, that thing that Manhattan is known for, the Upper West, the Upper East, those that are harder to get financing on, that you have to be approved in the building, you know, those did not get as high priced as the condos did. And then you had the foreign investors kind of pulling back, the dollar changing, you know, the values against foreign currency. So, you know, you were seeing weakness in the Manhattan market, condos to begin with. But the fact that it's trickling into the co-ops, that's what I still consider real New York, and I have to admit, because I am a real New Yorker.
100% agree with you.
Even though I live in Washington,
I would rather live in a co-op.
I grew up in New York, and I just feel like that's the heart of the market. And when you see that soften and you see that fear of the SALT, you know, the tax changes, that's really having an impact.
Yeah, Josh,
well, I would much rather own.
Give me that tax impact lowdown that you promised.
I'm sorry, one more time?
The tax impact. You said you were going to get to that.
Oh, yeah. Well, there's two issues that we can talk about. I don't know if you're referring to not deducting interest or on your mortgage, or if you're talking about you can't deduct your property taxes anymore. Which one do you want to start with?
It's the property taxes is the big one. I don't think the mortgage interest deduction affects that many people.
Well, not in my market, but in the middle of the country it does.
Right, but depending, in the middle of the country is much lower price, so the cap isn't going to affect the vast majority of those homeowners.
Accurate, but their income's, well, that's a whole different, okay. But anyway, the point I'm making is property taxes, not being able to deduct them, I think is, I mean, it's a huge problem. I don't think it's going to affect people that are in the income brackets that I sell houses to, because it's just annoying for them. But if you're buying a house and you're expecting to spend have have a, let's say, a $40,000 or $80,000, $10,000, $100,000 a year tax bill, if you can afford that, you can certainly afford the $50,000, or you can afford not to deduct them. It's just a real annoyance because it sucks. Like, oh shit, now, oh, you know, I just have an extra expense of $100,000 a year when I thought I would be able to deduct them. But I don't think that's going to affect our market.
Ryan, tie a bow around this for us, if you will. With all of the changes, both macro that are happening right now in terms of interest rates, and then changes that'll be coming into the fore that actually happened quite a while ago, tax-wise, as people are entering the real estate market in 2019, buyers, sellers, what's the overall feel, the overall message for what they should be looking out for, the attitude they should have, the numbers they should be looking at as they get into action in the year?
Right, and I'm glad I got to bring it back. When you really look across the whole country, next year we think prices will be up 2%, listings and sales will be down 2%. It's actually a pretty healthy equilibrium market, and it'll be that way next year. So while we talk about the high end has issues and certain cities on the coast have issues, overall housing is pretty healthy, and especially with the Fed slowing down rates, as it seems like they will, I think that's going to give a little bit of a boost to what was a slowing market. So I think my feeling on the housing is it's still a really good investment for people. It's beyond an investment because you get to enjoy where you're putting your money with your family and with your community. So to me, it's a really good investment over a long period of time as long as you take that framework. And I think housing, while there'll be pockets of highs and lows, I think overall it's pretty steady.
All right. Well, I guess people should hang in there, think long term. Next up on the podcast, Intel's Chief Financial Officer and Interim CEO, Bob Swan. And for now, thank you to Ryan O'Hara, CEO of Realtor.com, Josh Flagg. Once again, season 11 of his $1 Million Listing LA airs Thursday, January 3rd at 9 p.m. Eastern on Bravo, and CNBC's own Diana Olick. This has been Fort Knox, Rich Ideas and Powerful People. Thanks for being with us.